All right, welcome
Um,
back, everybody. Very excited today to have Barry on again for our second episode. Last video we covered retirement accounts, and today we're going to go a little deeper into that. What are some options you can purchase as far as stocks and index funds, ETFs?
Thanks, man. Good to be with you, and it's nice to see that you're down in sunny Florida,
Yep.
and I'm up in New York. We started school last week. We had kids last week for a couple of days, and the first thing we got into in my finance class was compound interest, and we talked about how this class that I teach is not a short-term class, and thinking long term is the way to go. And I explained to them that I've made mistakes over the course of my teaching career, and in terms of buying certain stocks and whatever. But fortunately, I've had a lot more success than failure, and I am looking forward to a really comfortable and happy retirement in a few years because of that. I've been doing it a long time, and I've enjoyed it. And one of the most important things is that I've learned from my mistakes.
What would you say to the people who think, the stock market, you're just gambling? Is it a gamble?
In certain aspects, it can be, but if you're thinking long term and you're buying good stocks and you're putting your money into things like the S&P 500, uh, you're putting your money into very very good companies that have been around forever, that have been great, that are great now, and I'm pretty sure will be great in 20, 30, 40 years. It's certainly a gamble that is worth taking.
Hmm.
If you're looking to get rich fast and buying stocks that are not really that good, and you've heard from somebody else who hasn't really done their research that you should throw some money into something, that's not the way to go. That certainly is a gamble. And you can look to stocks like AMC and GameStop and stuff like that. That's not for me. I'm not saying that it's not. You can do what you want, as an individual, as somebody who is looking to invest in the stock market. But I would not suggest, and I don't suggest to my students that they look to get rich fast, because it rarely works.
Right. Yeah, and the way I look at those, the meme stocks, it's a
Right.
modern lottery ticket. That's all it
Yeah.
is. And just to segue off that, I found a good article here showing how stock market's returns, over a 20-year period. So from 1926 to 2015, the S&P 500 has never had a negative 20-year span. So if you start at any year, go 20-year period, there's a 100% chance that the market was higher than when you began. But it just goes to
Right.
tell you, the longer your time horizon, the better off you will most likely be. As far as total returns, the worst total return over a 20-year period was 54%, but the worst 30-year total return was 854%.
Which goes back to the point of starting early. You start investing in something like the S&P over, at 22 out of college, and you retire at I can retire at 55 as a teacher in New York. Most people retire at 62, 65. That's 40 years right there.
Right.
So you don't want to wake up at my age at 50 and say, wow, I didn't put any money away. You want to wake up at 22, say, I'm going to do this over the next 40 years.
So what are some of your favorite investments, or your go-to? What do you like to invest in?
Well, my favorite individual stock has been Apple. I started investing in Apple in 2005, before the iPhone came out. And I did that because a student in my class did Apple for his stock project, and the stock went from 30 to 80 over a course of a couple months. And I said, wow, I should really start investing in that. So I learn as well as teach in my classes. Um, every kid, in my class had an Apple, not an iPhone, but an iPod, I guess, the original iPods. and it has, in the 16 years that I've been investing with Apple, it's just done fantastically well.
Right.
Not every day, not every month, not every year, but over the long haul, it's split, and it just continues to go up. And people love the iPhone. They wait online all night to get
Yep.
it. The morning after. When you go to a mall, the Apple store is always full, where a lot of these other stores, especially during the pandemic, are not. So that tells you something about the company. I thought that after Steve Jobs passed away, that might hurt the company, but Tim Cook has done a terrific job, I think, in my opinion, as CEO, and really brought the company to a lot of places that not many people could bring it.
Yeah, and
So individually, that would be one of my favorites.
Apple definitely, one of the best companies of all time, if not the best. And yeah, like you
Right.
said, they've done a great job now of, a lot of people were worried iPhone sales will either dry up or it can't keep growing forever. And here they are every
Right.
year, record amounts of revenue. And now they're getting into, subscription type stuff, software as a
Right.
service. And yeah, they keep doing great. I mean, great companies will continue to be great companies. And then I was
Yeah.
just pulling up here just to reiterate, like the importance of buying and holding for the long term. I mean, Apple's had some pretty significant dips along the way,
Yes, they have.
and so if you had sold there, you miss out on these insane gains that would follow. So over the last decade, let's say from November 2010 here, Apple's up 1,250%. So
Amazing.
if you were to, buy it and you're only planning to hold it for a few months and sell, you're probably going to sell yourself short. And
Right.
same thing with a company like Amazon. I mean, they've had big dips along the way, but they've come back and reached all-time highs time after time.
Yeah. Well, I was going to get into Amazon a little bit. I don't know own any Amazon myself, but I started an investment club at my school about 10 years ago, and we bought Amazon at 200. We bought 12 shares at 200, and we held them. And now those 12 shares are worth 3,400, 3,500. And it's obviously been the single best investment in the club. We also own some Apple and Starbucks together, and I also own some Starbucks myself, as well as Nike, Home Depot, Johnson and Johnson, Procter and Gamble, all terrific companies who I think have a wonderful future. And that's what I've learned to do. I've learned to invest in great companies, get the dividends every year, and I've been very, very happy and successful doing that. And lately, I've gotten into ETFs, and one of my favorite is through Vanguard, the S&P 500 ETF, and that's done incredibly well as well. And I think that has obviously what you showed before. That's a great place to start for a young person, for a person in their 30s and 40s, and even for a person of my age in his 50s.
Right. And then is that VOO, that's one of
Yes.
Vanguard Index funds, S&P 500 fund. And as you can see, yeah, I mean, over the long term here, it just keeps going up and to the right.
And even with that dip during the pandemic in 2020, it rebounded very nicely. And think about it, if the top 500 American companies fail over a long period of time, we're all in big trouble.
Yeah,
Right?
we'll have bigger problems to worry about.
Exactly. So I think that's a great place to invest long term for a young kid. Just keep on sticking money every month into an S&P mutual fund, into an S&P ETF, and you'll be very, very happy you did. Start at 22, 23, and look at it when you're 52, 62. You'll be very, very happy.
Right, and that's another one. Since 2010, up 300%. So if you just bought and hold it till now, you would have made 300% on your money. And index funds are, there's multiple reasons why they're great. One, no one statistically has been able to outperform the market over long periods of time. You might get
Right.
lucky for a handful of years, but over the long term, nobody can beat the market. And this index fund will just match the market's returns. So over long periods of time, like we said, up and to the right. So index funds are great because they'll match the market's returns. And then the other thing that's great about them, most people, I think, tend not to be very interested in following stocks and keeping up with all this stuff. So if you want to take a more passive approach, index funds are also great for that. Like Barry said, you just keep investing regularly and you don't really need to worry about how the business itself is doing because you own the best 500 companies that exist, and it'll adjust itself accordingly. If one company were to go bankrupt, the index fund just adjusts and it's going to add a new company, and
Right.
out with the old, in with the new, and you don't have to worry about it. They take care of all that for you.
And that's what I was going to say. If you're not a fan of trying to pick a stock or a couple stocks, because you don't know, you don't know how to do the research, or you don't know what the future is going to hold for every single stock. There's certainly a lot of people that feel that way, right? So this is a great way to get yourself into the market, in general. And there's also something called a total market fund, which you're buying every stock out there, and that's also a great way to invest long term.
Yeah, so I own this one, VTSAX, and same as VU, except you own
Right.
I think around 3,600 companies versus just the 500 companies that make up the S&P. But they tend to perform very similarly, as you could see, up almost 300%. And this
Well,
one's been around a little longer, so.
you look at a company like Apple. Apple is part of the S&P 500. They're part of the Nasdaq index, and they're also part of the Dow Jones index. So if whatever index you get into, you can buy great companies like Apple. So it's a good way to get involved if you're not sure about what you're doing as a new investor.
So yeah, as you can see here, here's their top 25 holdings. So by owning VTSAX or VU would be pretty similar. 5% of the fund is Apple. Then you got Microsoft, Amazon, Facebook, Google, Tesla, and so on. So you just own all the best companies. I think with the S&P, like these top 10 companies probably make up around 25% is just in these top 10 here.
And they're all different types of companies. Well, not all different, but certainly it's a mix of companies, mix of different sectors, which is what you want when you're investing long term.
Yeah,
there's consumer products, there's technology, there's banking, there's Berkshire Hathaway, there's cars, there's Google, there's Facebook. It's just a terrific mix of holdings.
Cover all your bases, and then you can see the total for the portfolio by sector. Yep, 27% tech, 16% financials, and so on. So you get a little bit of everything without having to do any work and find the companies on your own. So definitely
right.
A great alternative. Or I like to use, the index funds as kind of the base for my portfolio. And like I said, I think a lot of people who might not necessarily be interested in, tracking stocks, index funds are a great option for those types of people.
Just also be aware that these are not perfect as well. Back when I started teaching, I started investing in a science and technology fund through T. Rowe Price. And I was doing that through the 90s, and it went all the way up to 77, I remember. And then in 2000, the technology bubble burst and the Nasdaq stock market took a huge hit, and it went from 77 all the way down to 12. And I haven't looked at it in a long, long time, but I would imagine it's nowhere even still back up to 77. So I didn't really understand bubbles at the time, and it was not a heck of a lot of fun watching it drop that much. Because I thought technology would always be great, and I think long term it is, but I definitely got hurt pretty badly in 2000 when I was still learning a lot, and I lost a chunk of change, which wasn't a lot of fun back then because I was making a lot less and I had a lot less.
Right, and so that's a great point. Sector specific ETFs have their own set of risks, and like you said, if you're purely exposed to technology companies and there's a technology sell-off or something like the dot-com bubble and burst, I mean, yeah, those funds lose almost everything. I mean, even if you look at a company like Amazon, I think in the dot-com burst went from like $100 to $8 or something, maybe
Wow.
more. But yeah, so there's definitely, there's pros and cons to going like the sector specific route. Another one I like is QQQ,
Right.
which is let's see if I can pull up the chart here. Tracks the Nasdaq 100. So this is an index fund for the Nasdaq 100, which is mainly technology companies. And as you can see, since its inception in around 2001, let's say, or no, it's been around since 1999, I guess. Here, it's up 600%. So it has outperformed the S&P 500 over this time span. Especially over the last decade. I mean, tech has been on an insane bull run.
Right.
But with that being said, it doesn't mean anything for the next 10 years. And, if something bad happens with tech, I mean, this is obviously going to get clobbered, where then you'd probably be better off being in an S&P or a total market like we looked at. But this is another good option too. And you had mentioned earlier here, like stocks that pay a dividend. So dividends are another great way to approach things. And, I like to take a mixed approach where I have my index funds or my ETFs. I have some of my growth plays that I own, like Tesla, Apple, companies like that. And then you can also invest for dividends. So a lot of people think the only way to make money in the stock market, you have to buy a stock, hope the price goes up, and then sell for a profit. But lots of companies, especially the ones that have been around for a long time and tend to be more stable and consistent, pay dividends. So dividends are a distribution that they'll pay shareholders. So I think Apple, if we use them as an example,
I think it was 86 cents per share from what I remember.
So yeah, so Apple dividend yield is around 0.5%. So yeah, that comes out to around 86 cents. So they pay that annually. So for every share you have, you'll get the 86 cents. You have 100 shares, it's $86. And then, so Apple's a company, they have a pretty low dividend because they just started paying it, maybe 10 years ago?
Well, it was after Steve Jobs, because Steve Jobs did not like paying dividends.
Yeah,
He
so
liked accumulating cash, which allowed him to buy up other companies. And Apple had a ton of cash on hand during his years.
Yeah, so I own a company called AbbVie too, a healthcare company. So their dividend yield's a little higher, almost 5%. You can buy, there's all kinds of different companies that, might pay a little higher yield. AbbVie's considered like a dividend growth company, and, they've been growing their dividend consecutively for X amount of years. So that's another alternative. You can get higher dividends, and also over time, Apple keep increasing their dividend, and they keep having share splits, and all of a sudden you're getting a lot of money in dividends.
Right. Great point.
So you can there are ways to make money in the stock market. It doesn't have to just be, buying a stock, hoping the price goes up. You can invest in a great company like Apple and just collect that dividend for life. All right. Well, thank you for joining us, Barry, and look forward to doing another episode.
Yep, I love doing this. I greatly appreciate the fact that you're doing this and teaching and learning. I love talking money. I can do it all the time, and it's a lot of fun. Appreciate it.
Yeah, definitely a lot of fun, giving people a lot of value. All righty. See you guys next time.